The next section of our discussion focuses on the ongoing costs and income of running a business. To start with, we're going to look at the fixed costs, and we're going to look at the 12-month cash flow spreadsheet that you would have received as part of the training materials. As you open that document, you will see at the top are some general information about your business, how many hours you'll be open, your employee wage, number of employees, etc. We'll talk about that in a minute. And then we also go into income, which we'll talk about later, and variable costs, which are tied to income. So variable costs are those costs that have a connection to income, and you don't incur those unless you have income associated with them. But then as you move down to the bottom of the form, you have fixed costs. Fixed costs are the expenses that you will have on an ongoing basis with your business that will exist whether or not you're having sales come in the door. So for example, let's start at the top. Outside services, an example of that is trash removal. So while the amount of trash that's being removed may vary depending on how busy you are, you're probably going to have a fixed amount that you will pay to have trash removed every month. So we're, for the sake of discussion here, going to use $100 a month, which is not unusual for a business to pay for commercial trash pickup. So if you have commercial trash pickup, we'll budget $100 a month for that. Real estate taxes. Let's say you purchase the building, or you are responsible as a renter for the real estate taxes of the building that you're in for your business. Those taxes are probably paid in June and September each year. And let's say, for the sake of this discussion, that you're paying $2,000 a year in real estate taxes. So we're going to put $1,000 in June and $1,000 in September. And as we walk through this, the value of this particular form and being sure that you're forecasting in 12 periods out is so that you can see how your money is going to flow, how your money is going to come in, how your money is going to go out. And you can identify areas in the course of a year that you're going to have a deficit. So even if you have a business that's profitable for the full year, there may be months where you can say, I'm going to have $1,000 real estate tax bill this month. I may not make as much money, and you can prepare for that by setting money aside from previous months when maybe you made more. So that's the value of this form, and that's something, again, a bank is going to want to know that you've thought through all those pieces and you've planned and you have enough money planning to come in to be able to offset those costs and to be able to prepare for those down points in your expenses. So let's say advertising. Let's say we went through the marketing plan and we decided that we are going to spend an average of $250 a month in advertising. For this exercise, we're going to have that go straight across. And then in every month. In reality, you probably will vary how much you spend based on when your business is stronger than others. So if you have most of your sales in the holidays, you'll probably spend most of your advertising budget in November and December. If you're a seasonal business that focuses on summer, you're going to not spend money as much in December and January, but spend it more maybe April, May, June, July, August. So those are decisions you'll make. So as you fill out this form, think about those aspects. Website maintenance and setup. Let's say you're paying $75 a month to have someone maintain and host your website and handle the various aspects of that with you, help you if you have problems with your website, etc. Car delivery and travel could be your expense with your car. It could be, if you have employees, it might be reimbursement for their travel. If you have delivery expenses associated with your business. So if you're maybe a business that uses fuel as part of what you do, this might be a place you might put that. Let's say in the course of, in this business, maybe travel is more about going to a conference once a year. So let's say in September, you're going to go to a conference and you're going to spend $1,500 in travel. So we'll put that there just so there's something in that line item. Bank fees could be credit card fees. So if you're going to count your income as gross income, so this is how much you charged your customer, and then the credit card company took 2 to 3% of that, that would be a place to record that information. Something to consider, those of you who use Excel and other kinds of spreadsheet programs, if that's how you're going to use this line, you might want to look at creating a formula that's going to go up to your income, your cash receipts. And we're just going to say we're going to say 50% of your cash receipts are going to be credit card sales. So you're going to want to create a formula, and everyone has their favorite way of doing that. So you may have a different way you'd like to do that. But you might go up and capture your total revenue times 50% times, let's say you pay 3% to your credit card company. So now you have a formula that's going to offer a variable expense, even though this is in this fixed expense line item, but it's going to show you when you're going to, once you start putting revenue in there, it's going to calculate for you how much you can expect you'll have in credit card fees. Okay. Insurance. You're going to have a lot of different types of insurance probably associated with your business. If you have a building, you're going to have building insurance. If you have vehicles, you'll have vehicle insurance. You'll typically have general liability insurance, which means if someone comes to your business and falls down or eats something that makes them sick and they decide to sue you, then that insurance is there to cover you. You might have errors and omissions insurance if you're in a type of business where you're doing work for, maybe you're an accountant or you're an advertising agency and you accidentally make a mistake on something that you're doing that costs the company that you're working for significant amounts of money, and again, they sue you for that. That might be a policy that helps you cover that. You may also, if you have any employees at all from the first part-time employee, you would need to have workman's compensation insurance on them. That's a law in the state of Illinois. So that's where that's going to show up. If you borrow money from a bank and it's a substantial loan, the bank may ask you to have life insurance that names the bank as the beneficiary. So if you have that type of insurance, this is where you would put that number. So this is a total of all the different types of insurance you have for your business. So let's say that your business is a fairly risky type of operation. And again, those insurances all vary depending on the type of business you're in. If a business is more dangerous, there's more opportunity for potential loss for the insurance company, the insurance cost is going to be higher. If you're in an office environment, it's maybe, and you're not working with anything that's dangerous or high risk, the insurance may be lower. So let's say that you have $350 a month payments. So that's sort of a moderate type of risk in the business that you're in. So you're going to pay about $4,200 for insurance. You could pay that in advance in a lump sum. They may ask you to do that. They may want you to pay it on a semi-annual or quarterly basis. In a perfect world, it's nice if you can do it on a monthly basis. That way you know you have that expense spread across each month and it's an automatic cost for you. But you just know to put it in how your insurance works. Interest, this is where we're going to put the interest on the loan that we talked about, doing your startup costs, figuring out how much you're going to borrow. You'll plug that number into a commercial loan calculator and put in the amount of interest that's being charged in your area, what the length of repayment is on that. If you're buying property, the length of the repayment may be 20 years. If you're doing a commercial loan to buy equipment, It may be 5 years. So whatever your bank has determined that they would allow you as far as a repayment time and the amortization time of the loan and the amount of interest that you're paying. You'll put those numbers in, it's going to give you a payment. That payment will be a combination of principal repayment and interest. So you're repaying back on the loan and the amount you're paying the bank for borrowing the money. Usually have that structured as like your mortgage payment. You're going to pay a flat payment every month, but from month to month, the amount that's interest and the amount that's principal changes. So you may pay $500 every month. In the beginning, $495 of that might be going against interest, and only $5 goes to principal. The next month, maybe $10 goes to principal and $490 goes to interest, and it keeps changing over time. And as you get close to paying off the loan, the majority of what you're paying back is principal and the smaller amount is interest. So you are able, from an accounting standpoint, a tax standpoint, to deduct the interest portion of your payment, but not the principal portion. So when you're accounting for it here, you're accounting for it in your books, you're going to show the interest expense only in this line item. So we're going to say $290, and that number is going to drop a little bit every month, but in interest. And again, when it comes time, you're going to record the actual amount, or you can use an amortization spreadsheet that'll give you the actual amount here. But just so you have an example. And so then that's $240. Okay, and let's say your total payment is $500 a month. So the difference is the principal, the total payment minus the interest is your principal. So you're paying $500 a month, and we're accounting for that between the principal and interest line. So this should give us numbers to put there. So now on the form that we're filling out, you're accounting for the cash flow loss. You reduced your cash flow for the principal payment. But when you're figuring out your taxes at the end of the year, the amount you count as an expense is what shows above the line, which is the interest payment. Okay. Accounting and legal, let's say that you pay for QuickBooks and you have, let's say you have an employee. So let's say you pay about $65 a month for QuickBooks online. And let's say that you have an accountant then, though, that does your taxes for you every year. And let's say they charge you $800. So in April, you're going to have a little extra. You're going to have the amount for your accountant. Licenses and dues. Let's say you're the type of business that has to, it has a license that comes up. You may be a food service business and you have a health license, health department license. You may be a business that involves driving and you have driver's licenses or registration and fees that come up every year. But let's say you have some type of licensing that's due at the beginning of the year. And we'll put that number in there. Repairs and maintenance, no matter whether you're renting or buying, you're going to have some kind of repairs and maintenance associated with your business. It might be snow removal. It might be fixing the plumbing. It might be clean, having someone to come in to clean the operation periodically. So you're going to want to put anything you know is for fact cost you're going to have every month, and you're also going to want to put some money aside for those things you didn't plan on. So let's say we put $200 a month in this line item, thinking that there's going to be, over the course of the year, a couple of $1,000s worth of repairs and maintenance that has to happen. Supplies, and for this discussion, we're going to lump in office supplies and operational supplies. So these are going to be things that are not necessarily tied to the sales side of it. So it's not something you're going to replenish in supplies because of sales. It's more things like certainly printer ink or paper or pens or order pads, or you may have certain types of, I'm trying to think of what works well, maybe small wares in a restaurant. You have to replace spoons and mixing bowls and things like that occasionally. You may have, if you're doing lawn care, you may have the cord that goes on the weed whackers that you have to replace. Those kinds of things that you're going to have some cost for. And let's say in our business here, we're going to say it's relatively low cost for that kind of thing, and we're going to spend about $100 a month in supplies. Okay. Let's say you chose, rather than to purchase the property, you're going to rent the property. And so you maybe have, let's say, a $1,500 a month rent payment that we're going to pay. Utilities and power, I mean, $1,500 is a fairly substantial rent, so it's probably not a small property. But let's say your power may be $400 a month, your water might be another $30, sewer might be another $25. For this, let's just round it and say $450. So $450 that you're going to pay in utilities costs. Okay. Telephone and internet. Again, this is going to be, you may charge your personal cell phone to this because you're using it primarily for business. You may have a landline in your business. You may have internet costs associated directly with your business. This might be, maybe you're also putting, maybe you really have telephone, internet, and cable because you have a type of business that has a TV on in the waiting room. So let's say that you're going to spend between all of that $200 for telephone, internet, and maybe cable. Okay, so now for this, for the business that we've looked at, our fixed costs are around $4,000 a month. And that, for this discussion, again, includes the principal repayment, understanding that there are going to be some months. So, for example, in September, when we were making a payment on our taxes, and so we had some other costs that were exceptional in September. We did some travel that month. That's our highest month, was $6,290 for fixed costs. And then the lowest month we have is $3,790. So our expenses for the year are averaging, it's about $46,000, so a little under $4,000 a month is your typical expense, but there are months as high as $6,000. Okay, so those are the costs that you're going to have no matter what in running your business. Okay, now let's back up. Let's go all the way back to projecting revenue. We'll probably take just a little break here because this is a separate section, and I think this is a good time for you to do some projections of your own on your fixed expenses. Go ahead and take your sheet and start filling that out, and then we'll come back and we'll talk about revenue and how to forecast revenue. Great, thank you.